Two people started investing on the same day, same age, same income, same amount invested each month. They chose the same diversified index fund. They started with the same intentions and the same level of commitment. For the first 2 years, they had almost identical conversations about money. They both felt like it was working. The numbers were moving in the right direction, and the future felt like it was being built. Then year 3 arrived. The first person looked at their account balance and did something that roughly half of all new investors do at some point between year 3 and year 5. They stopped. Not dramatically, not all at once. First, they reduced contributions. Then they paused them. Then they redirected the money towards something that felt more immediate and more real. A renovation, a car, experiences they had been deferring. The account sat. The monthly deposits stopped arriving. The balance barely moved. The second person kept investing. Not because their circumstances were easier or their discipline was extraordinary. They kept going because they understood something specific about the math that the first person did not. They knew exactly when the numbers were going to change, and they knew that year 3 was not it. At age 60, the first person had approximately $214,000. The second person had $1.1 million. They started with the same money on the same day. The gap between them was not created by different incomes, different investment strategies, or different levels of financial sophistication. It was created by a decision made at year 4, at the precise moment that felt most justified, right before the math was about to shift entirely. This is what quitting investing in your 3rd, 4th, or 5th year actually costs. And this is why it keeps happening to people who are not careless, not uninformed, and not financially irresponsible. They simply did not know about the 8-4-3 rule. They did not know what was about to happen. Let me explain exactly how this works. The 8-4-3 rule describes a pattern that appears in consistent long-term investing that is almost never explained to people when they start. At historical average market returns of roughly 10% annually, a portfolio that you contribute to consistently will behave in a specific and predictable way across 3 distinct phases. In the first phase, which covers roughly the first 8 years, your wealth builds slowly. Not because compounding is not happening, but because the base is still small. Compounding is multiplying a number that has not grown large enough yet for the multiplication to feel significant. Each year, your percentage return is the same, but 10% of a small number is still a small number. The gains feel proportional to the sacrifice only at the theoretical level. At the emotional level, they feel inadequate. Then the second phase begins. In the roughly 4 years following that first phase, your portfolio adds approximately the same total wealth it took 8 years to build in the first phase. Read that again. The same amount, in half the time. Not because market returns suddenly improved or because you did anything differently. Because the base grew large enough during the first 8 years that 10% of it now produces meaningful, absolute gains each year. The compounding that felt invisible is now undeniable. Then the third phase. In the 3 years after that, your portfolio adds another amount roughly equal to what it accumulated in the entire first 8-year phase. Again, in 3 years instead of 8. The acceleration has now compounded the acceleration itself. The curve that looked almost flat for the first several years is now climbing at a steepness that bears no resemblance to how it started. Think about that for a moment. To put specific numbers to this, consider someone investing $500 per month starting at 25, earning 10% annually. By year 8, at age 33, they have accumulated approximately $67,000 in total portfolio value. It took 8 years of consistent discipline to build that. By year 12, at age 37, their portfolio is worth approximately $133,000. They accumulated roughly $66,000 more in just 4 years. The same amount that took 8 years to build arrived again in 4. By year 15, at age 40, their portfolio is worth approximately $212,000, another $80,000 in 3 years. And this is not an unusual period of exceptional returns. This is simply what the math does when the base is large enough. By the time they reach 60, that same $500 per month has grown to over $1.1 million. The final decade of that journey, from 50 to 60, adds more to their portfolio than the first 25 years of contributions and growth combined. This is what the 8-4-3 rule describes. Not a theory, a mathematical reality that plays out in virtually every consistent long-term investing scenario. The problem is that most people quit in year 3, 4, or 5, which puts them squarely inside the first phase, well before the curve bends, well before the acceleration is visible, and well before they have any emotional evidence that what they are doing is going to work. Let me show you the exact cost of that decision. If the person in the example above quit investing at year 4 and never resumed, their portfolio at 60 would be worth approximately $71,000. The roughly $16,000 they contributed over 4 years, plus market growth on that balance over the following decades, would produce $71,000 at retirement. Their counterpart who stayed invested, $1.1 million. The difference is just over $1 million, and the years that created it were not the later years, when the portfolio was large and the gains were dramatic. The years that created it were years 5 through 15, when the person who quit had already left, when the monthly contributions kept arriving into an account that was just beginning to bend toward acceleration. The quitter did not lose because their money performed poorly during the years they were invested. Their money performed exactly the same as their counterparts' money during those 4 years. They lost because they took their money out of a machine that was about to start running exponentially faster, at precisely the moment the machine looked least impressive. Now, let me walk through the 3 specific reasons people quit in year 3 to 5, because understanding why it happens is the first step toward ensuring it does not happen to you. The first reason is what behavioral economists call relative performance frustration. Your brain did not evolve to evaluate returns in absolute terms. It evolved to evaluate relative terms. You are not asking yourself whether your investment is growing at a historically reasonable rate. You are comparing it to other things: the colleague who mentioned a stock that tripled, the neighbor who bought a property that appreciated dramatically, the friend who put money into something speculative that paid off. Your 10% return is objectively strong. Emotionally, it feels weak because you are always aware of someone who got more somewhere else. Research from Dalbar's Quantitative Analysis of Investor Behavior, which tracks actual investor returns compared to market returns across multiple decades, consistently finds that the average investor earns significantly less than the market returns they are invested in. Not because the market failed them, because they move money in and out based on relative performance frustration, pulling funds from strategies that feel slow and chasing strategies that recently produced dramatic results. The Dalbar 2023 report found that over the prior 20 years, the average equity fund investor earned approximately 6.4% annually, while the S&P 500 returned approximately 9.8%. The gap is almost entirely behavioral. The market did not underperform those investors. They underperformed the market by abandoning it. The second reason people quit is an experience called the milestone gap. When you start investing, your brain creates an intuitive expectation of progress. You imagine that by year 3 or 4, you will have a portfolio that feels substantial, significant enough to validate the sacrifice of choosing long-term saving over immediate spending. When year 4 arrives and your account holds $30,000 or $40,000, it does not feel substantial. It feels like 3 or 4 years of discipline produced a number that you could have earned in less than a year simply by not investing and saving in a regular account instead. This is the milestone gap. The point at which your actual progress is real and positive, but falls short of the emotional milestone your brain expected to reach by now. The gap feels like evidence that the strategy is not working. It is not evidence of anything except that compound interest requires a base large enough to produce gains that feel meaningful, and 3 to 5 years of contributions have not yet built that base. Let me show you what the milestone gap looks like in actual numbers, because the specifics matter. Someone investing $500 per month at 10% annually has contributed $6,000 by year 1. Their account holds approximately $6,300. The $300 of investment growth that year could have been earned in a single afternoon of overtime. The strategy is technically working. Emotionally, there is no evidence of anything. By year 3, they have contributed $18,000. Their account holds approximately $20,800, $2,800 of gains over 3 years. That is less than 2 months of their contributions. The math is running exactly as expected. The account does not feel like it is running at all. By year 5, they have contributed $30,000. Their account holds approximately $38,600, $8,600 of gains. Meaningful in absolute terms, but spread across 5 years of consistent monthly investing, it feels like the slowest possible accumulation of a number that still feels small. This is the maximum milestone gap. Year 5 is when the emotional case for continuing is at its weakest, and the emotional case for quitting is at its most reasonable. Here is the counterintuitive reality. The gap between your portfolio value and your emotional milestone is not widest at year 10 or year 15, when your balance is larger. It is widest at exactly year 4 and year 5, because your expectations were calibrated in year 1 and your balance has not yet crossed the threshold where the math visibly accelerates. Year 4 is the maximum distance between expectation and reality, which is precisely why it is the maximum risk point for quitting. If you can survive year 5, the gap begins closing rapidly. By year 8, your portfolio is producing annual gains in a single year that exceed what the entire first 3 years of investing produced. By year 12, the monthly growth on your account alone is approaching what you contribute each month. By year 15, you are earning more from investment returns in a year than you contribute in that same year. The milestone your brain imagined in year 1 finally arrives, and then it keeps accelerating past it. The third reason is the catalyst moment. Almost nobody who quits investing does so on an ordinary Tuesday with nothing happening. They quit when something else demands the money. A financial pressure, an opportunity, a sudden compelling use for the funds that has been sitting in a brokerage account growing at a rate that does not feel urgent. The car breaks down, the kitchen needs renovation, a business opportunity appears, a relationship changes the financial picture. The catalyst moment is not the real reason people quit. It is the trigger. The real reason is that they have not attached enough value to the account to protect it when the trigger arrives. And they have not attached enough value because the account has not yet reached the phase where its growth is visible and dramatic and emotionally significant. People with $200,000 in an account fight for that account when the catalyst moment arrives. People with $35,000 in an account find it easier to rationalize a withdrawal when a competing demand appears. The $35,000 does not feel irreplaceable. The decision to use it for something concrete and immediate feels logical rather than catastrophic. What makes the catalyst moment so dangerous is the timing asymmetry. The competing demand is visible, immediate, and concrete. The renovation estimate is a specific number. The car repair cost is a specific number. The cost of withdrawing from your investment account is invisible, deferred, and abstract. Nobody hands you a bill for $700,000 when you make the withdrawal. You feel no immediate consequence. The account goes to zero or near zero, you solve the immediate problem, and life continues. The cost appears only decades later when you run the retirement math and realize what that balance would have become. Think about that for a moment. What they do not calculate in the moment of the catalyst is the future value of what they are removing. $35,000 at year 4, left invested for 30 more years at 10%, becomes $611,000. The renovation that costs $35,000 costs $611,000. That is the price that never appears on the estimate. It is the number you need to calculate and keep visible before the catalyst moment arrives, not after it. Let me walk through what the quitter's account looks like at every major milestone, so the cost becomes concrete rather than abstract. Someone who invests $500 per month for 4 years and then stops has a portfolio worth approximately $29,000 at the moment they quit. Over the following decades, with no additional contributions, that $29,000 grows as follows at 10% annually. After 10 years, it is $75,000. After 20 years, it is $207,000. After 30 years, it is $506,000. That sounds substantial, and it is not nothing. But compare it to the person who kept contributing $500 per month across the same timeline. After 10 years of continuing contributions following year 4, $519,000. After 20 years, $1.6 million. After 30 years, $4.3 million. The quitter's $506,000 versus the continuer's $4.3 million. The entire difference was created not by the contributions made after year 4, but by the compounding that began accelerating in year 8 and has not stopped since. The quitter captured none of it. Now look at the year-by-year progression for the person who stayed, because the 8-4-3 acceleration becomes impossible to ignore when you see it mapped out. At year 8, their portfolio holds approximately $67,000. They have contributed $48,000 from their own pocket. Investment growth has added $19,000. The growth still feels smaller than the contributions. At year 12, the portfolio holds approximately $133,000. They contributed $48,000 more in the 4 years since year 8, but their portfolio added $66,000 of value in that same period. For the first time, the investment growth in a 4-year window exceeded what they personally contributed in that same window. The machine started running faster than they were feeding it. At year 15, the portfolio holds approximately $212,000. In the 3 years since year 12, they contributed $18,000. Their portfolio added $79,000 of value. Investment growth in 3 years outpaced 3 years of contributions by a ratio of more than 4-to-1. This is what the 8-4-3 rule looks like in practice. The same percentage return producing dramatically larger absolute results as the base grows. The person in year 4, sitting on $29,000, is looking at the machine before it has enough fuel to run at its designed speed. The person in year 15 is watching it run. Here is what I find most important about these numbers. The person who continued investing did not dramatically increase their contributions. They did not find a better fund or make smarter stock picks. They added the same $500 every month. The only thing that separated their outcome from the quitters was presence, being in the account when the math changed. Wealth built through compounding does not reward intelligence or sophistication. It rewards persistence and presence at the moment of acceleration. The 8-4-3 rule does not care how financially savvy you are. It cares only whether you are still invested when phase 2 begins. Let me give you specific guidance for making sure you are. The first thing to do is recalibrate your measure of progress. If you are currently in year 1, 2, 3, 4, or 5 of investing, your portfolio balance is not an accurate measure of whether the strategy is working. The correct measure is whether you are still contributing consistently. The account growing slowly is not a symptom of failure. It is the expected condition during the first phase of a process that the 8-4-3 rule predicts will accelerate dramatically in year 8. Judge yourself by consistency, not by current balance. The second thing to do is calculate the future value of what you have right now. Whatever your current portfolio balance is, find a compounding calculator and enter that balance, your expected annual return, and the number of years until retirement. The number that appears is the minimum of what quitting today will cost you, not the balance you see on screen. That future value. If your current balance is $40,000 and you are 30 years from retirement, the future value at 10% is approximately $700,000. That is the real price of treating your account as available funds. The third thing is to make the money difficult to access. The catalyst moment is almost always sudden. A financial pressure arrives, and the path of least resistance is the account you can log into and liquidate within 48 hours. Making that path more difficult buys you time to think rather than react. Move investments to accounts with withdrawal barriers. Set up automatic contributions that happen before you see the paycheck. Create a structural gap between the impulse to quit and the ability to act on it. Most people who pause for 48 hours before making a withdrawal decision do not make the withdrawal. Most people who can act instantly do. The fourth thing is to understand precisely when you are in the highest risk window. Year 3 through year 5 is when most investors quit. You are now aware of this. If you are currently in that window, you are not experiencing something unusual. You are experiencing what the data predicts virtually every investor will feel at this stage. The accounts are not growing dramatically. The emotional case for continuing is weak. The 8-4-3 rule says this is exactly what year 3 to 5 is supposed to feel like. It also says that year 8 is coming, and year 8 is when your counterpart who quit is going to wish they had stayed. If you are past year 5, you are through the highest risk window. The curve is beginning to bend in ways that will become visible over the next few years. The distance between your portfolio's current behavior and its future behavior is closing. Quitting now would be the financial equivalent of planting a garden for 5 years, surviving every drought and every week that nothing seemed to grow, and then pulling up the plants the week before the harvest. If you have already quit, the answer is not to grieve the compounding you missed. The answer is to restart and understand that you are beginning a new 8-year first phase. The math from this point forward still works. The 8-4-3 rule does not require perfect continuity from age 22. It requires only that you begin and stay. Picture your investing account 15 years from now. In one version of this future, You look at the balance and you cannot quite believe what you are seeing. Not because any single year was extraordinary, but because the gains from the last 3 years alone exceed everything you contributed in your first 8 years combined. You understand now, in a way you could not understand it intellectually, what the 843 rule was describing. You are on the other side of the curve. In the other version, you look at a number that is fine. Not catastrophic, not hopeless. Fine. The money you withdrew in year 4 bought what it bought. The renovation happened. The catalyst moment was handled, but 15 years later, you are running the calculation of what would have been. And you know the answer. You know which phase you would be in right now. You know the acceleration you would be experiencing instead of reading about. Both of those future versions of you started in the same place. They felt the same thing in year 3 and year 4. The same frustration, the same milestone gap, the same competing demand for the money. The only difference between them is one piece of information. You are not experiencing slow growth. You are experiencing phase 1 of a process that the math says changes entirely in year 8. Stay in the account. The 8 to 4 3 rule is already running.